You might think buying property in New Jersey is always a smart move. But what if I told you there are cities where your dream home could turn into a financial nightmare? In this video, top 10 cities in New Jersey you should avoid buying property in right now. Warning: we're diving deep into the darker side of the New Jersey housing market. Places where overvaluation, rising crime, and economic uncertainty are quietly eroding property values, while most buyers remain in the dark. We're not talking rumors, we're talking real data, real trends, and real red flags every smart investor should know before putting a single dollar down. From housing markets that look affordable but are actually collapsing, to communities where local fundamentals just don't add up. This is the video every homebuyer and investor needs to see before making their next move. So before you sign that deal or fall in love with a listing, watch till the very end, because one of these cities might just be on your radar right now. Hit that like button, subscribe to the Globe Realty, and let's dive into the truth about New Jersey real estate. Number 10. Lindenwold, New Jersey. On the surface, this small Camden County borough might look like a hidden gem for budget-conscious buyers, but dig a little deeper and you'll see why it's on this list. The numbers tell a story most agents won't, and it's not a comforting one. Home prices in Lindenwold have been climbing at a pace that simply doesn't make economic sense. According to Home Stratosphere, property values here have surged nearly 189% since 2016, one of the fastest growth rates in the state. The median home price now sits around $168,000, which on paper seems affordable compared to other parts of New Jersey. But when you look at the fundamentals, the local economy, wages, and affordability, the warning signs start flashing. The median household income in Lindenwold hovers just above $55,000, far below the state average, and nearly a quarter of the population lives below the poverty line. That imbalance between incomes and housing costs is a red flag. It means buyers are stretching further just to afford homes, creating a fragile market where one small economic shock can send values tumbling. Then there's the ownership issue. Only about 1/3 of Lindenwold's housing units are owner-occupied, which means investors and renters dominate the market. Low ownership rates often translate into less neighborhood stability, weaker property upkeep, and greater price volatility when interest rates shift or investor confidence wanes. Combine that with the area's heavy dependence on Philadelphia commuters, and you get a recipe for potential trouble. Lindenwold's appeal largely rests on its convenient PACO train connection to Philly. But what happens if remote work continues to grow, or if fuel prices rise, or the regional job market shifts? That commuter demand propping up home values could vanish almost overnight. And here's the kicker. Lindenwold has one of the highest property tax rates in New Jersey, with an equalized rate of about 4.81%, more than double the state average. So while the homes look affordable at first glance, the long-term carrying costs are anything but. Between rising taxes, modest income levels, and inflated property prices, Lindenwold is starting to look less like an up-and-coming market and more like a ticking time bomb for unwary buyers. So ask yourself this: are you buying into genuine growth, or just getting caught in a short-term bubble? What happens if values drop 10% or even 20% in the next few years? Would you be able to hold the property, or would you be forced to sell at a loss? Lindenwold may feel like a deal today, but when fundamentals don't match the hype, those deals often turn into regret. Number 9. Willingboro, New Jersey. On paper, Willingboro looks like a strong middle-class suburb. Quiet neighborhoods, proximity to Philadelphia, and homes that appear reasonably priced compared to other parts of the state. But here's the truth most real estate agents won't tell you. Willingboro's market growth has far outpaced its fundamentals, putting it at serious risk of a correction. Over the past few years, home prices in Willingboro have grown at an alarming rate. According to Redfin, the median home price now sits around $350,000, a jump of nearly 40% since 2020, far higher than wage growth or inflation. But what's fueling this surge? It's not strong local economic expansion or rising incomes. It's speculative demand, investor interest, and a wave of out-of-town buyers searching for affordable New Jersey homes near major highways. The problem is, when prices rise faster than the local economy can support, it usually ends in one way: a market correction. Willingboro's median household income stands at about $92,000, which seems healthy until you realize how much home prices have sprinted past sustainable levels. A growing number of residents are stretching their budgets thin, relying on high-interest mortgages just to secure a home. If mortgage rates tick up again, or the broader housing market cools, Willingboro's inflated prices could deflate quickly. Home Stratosphere recently ranked it among New Jersey's top overvalued housing markets, with a crash risk percentage exceeding 70%, a serious warning sign for anyone thinking of investing here. Then there's the local dynamic. Willingboro is heavily suburban, with limited new job creation and rising property taxes that eat into homeowner equity. The average property tax bill sits above $8,000 annually, one of the highest in the state. When you mix that with slowing demand and rising costs, it's a tough environment for appreciation to continue. And here's where it gets more controversial. Many homes in Willingboro are now being flipped at unrealistic prices, with cosmetic upgrades masking deeper issues like outdated infrastructure or declining neighborhood stability. So, if you're considering buying in Willingboro, ask yourself, are you investing in a stable community with long-term fundamentals, or a market priced for perfection that could stumble the moment economic winds shift? Buyers chasing short-term appreciation might find themselves holding properties that lose value faster than they can build equity. Sometimes, the best investment move isn't jumping on the trend. It's recognizing when the market's already overheated. And Willingboro? It's starting to feel a little too hot for comfort. Number 8. Woodlynne, New Jersey. Blink and you might miss it. That's how small Woodlynne is. But don't let its size fool you. And when you look at the numbers behind this market, you'll quickly see why. Woodlynne has just about 2,900 residents and fewer than 1,000 housing units, according to the latest census data. That's not just small, that's micro. And in real estate, micro markets behave differently. When your housing stock is that limited, even the smallest market shock, a few distressed sales, an exodus of landlords, or a local employer downsizing can send property values swinging wildly. It's what economists call high volatility, and in Woodlynne's case, it's amplified by another problem: overextension. Let's break that down. Home values here have surged by over 120% in less than a decade, according to Zillow data. Yet the median household income is under $50,000, well below the state average. That gap means the people buying or renting in Woodlynne are often financially stretched, paying more than they can comfortably afford just to stay in the market. When interest rates rise or inflation eats into disposable income, that strain becomes unsustainable. And that's when you start to see defaults, foreclosures, and sudden price drops. And here's where things get even trickier. Woodlynne sits in Camden County, an area that's struggled for decades with economic instability and high property taxes. Despite its proximity to Philadelphia, job growth here has been minimal, and many residents rely on commuting to other towns for work. That commuter dependence adds another layer of risk. If fuel prices rise or regional employment dips, housing demand in small boroughs like Woodlynne can vanish almost overnight. But the most concerning factor? Investor speculation. A growing share of Woodlynne's limited housing stock is being snapped up by investors betting on future appreciation or rental income. In 2024, investor activity made up nearly 35% of all transactions, a red flag for market imbalance. When investors pull back, and they always do when returns tighten, prices in small markets like this can collapse faster than anyone expects. So here's the big question. Would you risk your hard-earned money in a market so fragile that just a few sales could swing prices 10 to 15% in either direction? In larger cities, those ripples barely register. But in Woodlynne, they're earthquakes. The math just doesn't favor long-term stability here. Woodlynne may look affordable now, but affordability means nothing if your home's value can tank overnight. Number 7. Pleasantville, New Jersey. The name might sound charming, but Pleasantville hasn't been very pleasant for homeowners or investors lately. On paper, it seems like an affordable coastal alternative near Atlantic City, but the data paints a much riskier picture. Let's start with the fundamentals. Pleasantville's median home price currently hovers around $230,000, up nearly 80% since 2020, according to Zillow. That might sound great for sellers, but here's the problem. Local incomes haven't kept up. The median household income in Pleasantville sits at just around $47,000, far below the state average of $96,000. That's an alarming disconnect. When home prices grow nearly twice as fast as local earnings, you're looking at a market built on fragile demand, one that's vulnerable the moment interest rates tick higher or credit tightens. And that's not just speculation. We've seen this story before. Pleasantville was one of the hardest-hit areas during the 2008 housing crash. Home values plunged nearly 40%, and it took over a decade for the city to recover. Fast forward to today, and the same warning signs are flashing again. Overextended prices, stagnant wages, and an increasing share of residents spending more than 35% of their income on housing. That's what financial analysts call severe cost burden, and it's often the first crack before a market correction. Another major concern? Poverty. Pleasantville's poverty rate sits at roughly 25%, nearly 3 times the national average. High poverty rates tend to correlate with weaker buyer demand, elevated rental turnover, and higher foreclosure risks. Combined with Atlantic County's shaky employment base, heavily reliant on the unpredictable tourism and casino industries, you've got an unstable foundation for sustained property growth. And here's where it gets controversial. Many investors are still pouring into Pleasantville, hoping to catch the next wave of affordable housing appreciation. But let's be honest, affordability means nothing if your investment is sitting on a bubble. The truth is, the city's real estate market is moving faster than its economy can handle. So ask yourself this: if the local economy can't support current prices, what happens when the next market slowdown hits? Will Pleasantville see another repeat of 2008? Or worse? The numbers suggest it's not a question of if, but when. Pleasantville might look cheap and promising right now, but cheap doesn't always mean safe. Sometimes it's just a trap waiting to spring. Number 6. Orange, New Jersey. This Essex County city has a housing market that's anything but bright right now. Let's start with the pattern that never seems to end. Boom, bust, repeat. Orange has one of the most historically unstable housing markets in New Jersey. During the 2008 crash, home prices here plummeted by nearly 45%, one of the steepest drops in the entire Newark metro area. Fast forward to the pandemic boom, and the market roared back, with median prices shooting up by almost 90% between 2020 and 2023, according to Redfin. But here's the kicker. That surge wasn't driven by local economic growth. It was driven by investor speculation and buyers priced out of nearby Newark and East Orange. Now, as interest rates remain elevated and affordability collapses, we're already seeing cracks form. Price growth has slowed dramatically, inventory is creeping up, and homes are sitting longer on the market, a sign that the frenzy is fading. The median home price in Orange is hovering around $425,000. Yet the median household income remains under $55,000. That means many buyers are stretching far beyond what's financially sustainable just to enter the market. And that's where volatility creeps in. When a city's real estate values depend more on outside investor enthusiasm than on local income stability, it's a ticking time bomb. Orange has always been sensitive to shifts in the economy. Even a modest downturn or change in mortgage rates could trigger another sharp correction, especially since about 45% of residents are renters, leaving a smaller pool of long-term homeowners to stabilize prices. But it's not just about numbers. It's about perception. Many investors see Orange as the next up-and-coming market, close to Newark and NYC, with convenient transit links. But here's the uncomfortable truth. Proximity doesn't equal prosperity. The city still faces challenges like aging infrastructure, high property taxes, and a relatively high crime rate compared to the state average. These factors keep resale demand unstable and make long-term appreciation uncertain. So, let me ask you, is it really worth buying into a market that's shown you, time and time again, that it can't sustain growth without crashing? Some might call Orange a hidden gem, but if you look closely, that shine might just be the glare before another downturn. For cautious buyers and smart investors, orange is waving a big red flag, and ignoring it could be a very costly mistake. If you are finding this video eye-opening, do me a favor and hit that like button, subscribe to the Globe Realty, and turn on the notification. It will help us reach out to more people who equip themselves with real insight into real estate before investing. And now, the top 5 on this countdown. Number 5. Asbury Park, New Jersey. Now here's a name that sounds like coastal charm and summer vibes. But if you're thinking about investing or buying property in Asbury Park right now, you might want to hold that thought. This seaside city has been the poster child for New Jersey's gentrification boom, and now it's showing early signs of the same overextension that leads to painful corrections. Let's start with what's driving the hype. Asbury Park became a magnet for developers and remote buyers during and after the pandemic. Ocean views, a revived downtown, and that classic Jersey Shore feel turned it into a hotspot for second home buyers and short-term rentals. Median home prices surged to over $750,000 in 2024. That's up more than 65% in just 4 years, according to Zillow. But here's the concern. Local incomes haven't caught up. The median household income in Asbury Park is still below $65,000, creating one of the widest affordability gaps in the entire Monmouth County area. This means many locals are priced out, and the market's growth is heavily dependent on external demand, wealthy out-of-town investors, Airbnb operators, and seasonal buyers. But what happens when those external forces pull back? We've seen it before. Remember what happened to beach towns when the short-term rental market cooled off in 2023? Vacancy rates shot up, price cuts followed, and panic selling wasn't far behind. Now let's talk about something that most realtors conveniently avoid mentioning: crime and volatility. Asbury Park has one of the highest property crime rates in coastal New Jersey, with burglary and theft incidents nearly 40% above the state average, according to Neighborhood Scout's latest data. That adds an extra layer of risk for investors banking on vacation home returns. If tourists start to perceive the area as unsafe, or if insurance premiums climb, which they already are, rental yields can drop fast. And the volatility doesn't end there. The city's housing market has proven incredibly sensitive to interest rate changes and economic swings. One minor dip in the luxury or second home segment can send shockwaves through the entire local real estate economy. Remember, Asbury's revival is still relatively new. Strip away the trendy restaurants and beach events, and you'll find that long-term, sustainable economic growth hasn't fully materialized. So here's the question. Are you buying a lifestyle dream or a market bubble with a view? Because when external demand dries up and fundamentals can't support the prices, it's the last buyer holding the bag who feels the pain. Asbury Park may be beautiful on the surface, but beneath that glimmer lies one of the riskiest housing markets in New Jersey right now. Number 4. Atlantic City, New Jersey. This one's going to ruffle a few feathers, because for decades, Atlantic City has been marketed as the Vegas of the East Coast. But when it comes to real estate, that glitzy image hides some very real risks. In fact, Atlantic City's property market is one of the most fragile in New Jersey, and if you're considering buying here right now, you might want to think twice. Let's start with the basics: crime and volatility. According to recent FBI and Neighborhood Scout data, Atlantic City ranks among the top 5 most dangerous cities in New Jersey, with a property crime rate nearly 3 times the state average. That's not just petty theft. We're talking burglaries, car break-ins, and vandalism that directly impact property values and insurance costs. For landlords, that means higher premiums and tenant turnover. For homeowners, it means resale anxiety and shrinking appreciation. But crime isn't the only red flag. Atlantic City's entire economy is built on one very unstable foundation: tourism and casinos. When tourism is booming, money flows and home values rise. But when it slows, due to weather disruptions, regulatory changes, or broader economic downturns, the city's economy takes a hit almost overnight. Remember the pandemic lockdowns? Atlantic City's unemployment rate spiked above 30%, one of the highest in the entire country. That kind of shock exposes how dangerously dependent the local housing market is on casino-driven spending. Now, even with the recovery and a bit of new development along the boardwalk, the fundamentals haven't really changed. The median home price sits around $220,000, which might sound like a bargain, but cheap doesn't always mean safe. In many cases, it's cheap because investors and homebuyers know how unpredictable this market can be. Many properties sit empty during the off-season, and short-term rental income can swing wildly from month to month. And here's a deeper issue few people talk about. Atlantic City's population has been shrinking for years. Census data shows a population decline of nearly 10% over the last decade, and that's a red flag for long-term housing stability. When people leave, neighborhoods hollow out and property maintenance declines, all of which drag the market further down. So here's the big question. Would you buy real estate in a city where your investment depends entirely on whether tourists keep coming to gamble? Because if there's one thing history has shown, it's that Atlantic City's fortunes rise and fall as fast as its dice roll. For investors and buyers seeking stable returns, this is one New Jersey market you might want to stay far, far away from, no matter how tempting that oceanfront discount looks on paper. Number 3. East Orange, New Jersey. Now, if you've been following the New Jersey housing market lately, you've probably heard the hype. East Orange is booming. Investors, flippers, and first-time buyers are all talking about it as the next big thing. But here's the uncomfortable truth. Beneath all that buzz lies one of the most overvalued and unstable markets in the entire state. Let's look at the data. The median home price in East Orange currently hovers around $430,000, according to Redfin. And that's nearly 96% above its sustainable level when adjusted for local incomes and long-term fundamentals. Think about that. We're not just talking about homes being a little pricey, we're talking about prices that have completely detached from what the average resident can realistically afford. The median household income here is just over $55,000, which means the typical family would need to spend far more than the recommended 30% of their income to own a home. That's a textbook setup for a market correction. And history doesn't exactly give buyers confidence. East Orange has been through multiple housing crashes over the past 2 decades. During the 2008 crisis, prices here dropped more than 50%, one of the worst declines in northern New Jersey. Even during the more recent pandemic boom, the recovery wasn't driven by local demand. It was driven by outside investors looking to cash in on cheap properties near New York City. Now that interest rates have soared and those investors are pulling back, the cracks are starting to show again. Let's be honest, East Orange's market feels eerily familiar. We've seen this movie before: a wave of speculative buying, quick appreciation, then an inevitable pullback. But what makes this cycle even more concerning is the lack of local economic diversification. Unemployment remains higher than the state average, and job growth hasn't kept pace with housing inflation. When a city's prices grow faster than its economy, it's not a sign of prosperity, it's a sign of imbalance. So ask yourself, would you pour your savings into a market that's already stretched to its limit, hoping the bubble doesn't pop before you sell? Because that's the gamble in East Orange right now. The bottom line? East Orange may look like an affordable alternative to New York, but its market fundamentals tell a different story. One of dangerous overvaluation, high volatility, and a track record that doesn't end well for latecomers. In short, this is one New Jersey city where buying high could soon turn into selling low. Number 2. Camden, New Jersey. Now this one shouldn't come as a surprise to anyone who's been following New Jersey's real estate trends. Camden has long been one of the most talked about, and let's be honest, most controversial housing markets in the state. Yet despite all the city's ongoing redevelopment projects and government-backed revitalization plans, Camden still lands near the top of our list of top 10 cities in New Jersey you should avoid buying property in right now. And here's why. Let's start with the hard truth: crime. Camden consistently ranks among the most dangerous cities in America, not just in New Jersey. According to the latest FBI data, Camden's violent crime rate is nearly 5 times higher than the national average. That's not a typo, 5 times higher. The city records over 1,500 violent incidents per 100,000 residents annually, and property crimes remain more than double the state average. Now, ask yourself this. If you were a potential homebuyer, would you risk your family's safety to save a few $1,000s on a mortgage? Or if you're an investor, how easy do you think it would be to resell or rent out a home in a city that still struggles to shed its reputation for violence? That's the second major red flag. Resale risk. The perception of danger sticks, even when crime starts to decline. Camden's median home price is around $125,000, one of the lowest in New Jersey, and at first glance, that looks like a bargain. But cheap real estate doesn't automatically mean good investment potential. The problem is demand. Most buyers are hesitant to move into an area where safety remains a concern. That means your resale options are limited, appreciation is slow, and if the market dips, your equity can vanish almost overnight. And even though there's been talk of revitalization, like the waterfront developments and corporate relocations, the reality is that local economic benefits haven't reached most residents. The poverty rate still sits above 32%, and unemployment remains one of the highest in the state. Combine that with aging housing stock, high property taxes, and limited financing options, and you've got a market that's tough to enter, tougher to sustain, and almost impossible to exit profitably in the short term. So let's be real. Camden isn't just a risky play. It's a high-stakes gamble in a city still rebuilding its foundations. You might see some developers betting on the next big turnaround, but history hasn't been kind to that narrative. Until Camden can fix its safety issues and restore buyer confidence, this is one New Jersey market that's simply not worth the risk, no matter how tempting that price tag looks on Zillow. Number 1. Trenton, New Jersey. Now you might be thinking, wait, the capital city? Isn't that supposed to be one of the most stable markets? Well, that's exactly the problem. On the surface, Trenton looks like a safe bet. Government jobs, central location, historic neighborhoods. But when you dig deeper, the numbers tell a very different story. Let's start with the big one. Trenton has one of the highest housing market crash risks in all of New Jersey. According to Home Stratosphere and other recent market risk analyses, Trenton ranks among the top New Jersey metros most likely to see a price correction in the next 12 to 18 months. Why? Because home prices are running way ahead of fundamentals. The median home price here is roughly $275,000, up more than 45% since 2020, while the median household income has barely moved, hovering just around $49,000. That means affordability is being squeezed, and locals are over-leveraging to buy into a market that's already stretched thin. When prices rise faster than wages, history shows us exactly what happens next. The market corrects. And Trenton's track record proves it. During the 2008 housing crash, prices here fell by nearly 40%, and recovery took more than a decade. Fast forward to today, and we're seeing the same dangerous signals: inflated valuations, yet weak income growth, and buyers rushing in out of FOMO rather than fundamentals. But the risk doesn't stop at the housing data. Trenton also battles one of the highest violent crime rates in New Jersey, and that's something investors and homebuyers simply can't ignore. FBI data shows violent crime in Trenton is nearly 4 times higher than the national average, and property crime sits well above the state median. That not only drives up insurance costs, but also depresses long-term appreciation and rental demand. Even in revitalized areas, many buyers hesitate to plant roots when safety and stability remain uncertain. So, ask yourself, if a city's market is already overvalued, if incomes can't support prices, and if safety concerns weigh heavily on perception, what happens when the next economic slowdown hits? Trenton's real estate market is walking a tightrope, and one small shake, interest rates, job losses, or regional downturn, could send it tumbling. The harsh truth? Trenton may be the capital of New Jersey, but right now, it's also the capital of crash risk. For investors and homebuyers seeking stability and sustainable growth, this is one city where the warning signs are flashing bright red, and ignoring them could cost you dearly. And there you have it, the top 10 cities in New Jersey you should avoid buying property in right now. From small boroughs teetering on volatility to major cities where crime, overvaluation, and economic instability collide, one thing is clear: not every affordable deal is a smart investment. Here's the truth. The New Jersey housing market might look hot on paper, but beneath the surface, a lot of it is being held together by shaky fundamentals. We've seen explosive price growth, but we've also seen deep cracks, from overextended buyers and stagnant wages to rising insurance costs and shifting investor sentiment. And as we've discussed throughout this video, these red flags aren't just theoretical. They're backed by hard data and real market behavior. So whether you're a first-time homebuyer, a seasoned investor, or someone just keeping an eye on New Jersey real estate, the key takeaway is this. Don't get caught in the hype. Always look beyond the listing price. Ask, is this market sustainable? Are jobs growing? Are prices tied to local income or just investor speculation? Because when a market's fundamentals don't line up, even the most promising zip code can turn into a money pit overnight. New Jersey has plenty of great places to buy, but these 10, they're flashing warning signs, and sometimes the best investment decision you can make is the one you don't make. If you found this breakdown helpful, hit that like button, subscribe to the Globe Realty, and turn on the notification bell so you never miss our weekly market deep dives and property insights that could save you thousands. And now, I want to hear from you. Which of these cities surprised you the most? Have you seen similar warning signs in your area? Drop your thoughts in the comments below, because the conversation about where not to buy is just as important as where to buy next.